Hey everyone, welcome back to Accounting Pro, the place where accounting becomes simple and fun. If you're new here, hit that subscribe button and join our growing community of accounting pros. Today we're diving into a super foundational topic. What is a T account? Whether you're a student, a small business owner, or just curious about accounting, by the end of this video, you'll understand T accounts from A to Z, with examples that make it crystal clear. So grab a coffee, a notebook, and let's get started. First things first. What exactly is a T account? Simply put, a T account is a visual tool accountants use to track transactions in a way that's easy to understand. It's called a T because, well, it looks like the letter T picture. This, a vertical line down the middle and a horizontal line across the top. On the left side, we have debits, and on the right side, we have credits. That's it. Super simple, right? But here's the kicker. T accounts are the building blocks of double-entry bookkeeping, which means every transaction affects at least two accounts. Don't worry if that sounds confusing. I'll walk you through it step by step with examples. So, why do we even bother with T accounts? Imagine you're running a business, and money's flying in and out. Sales, expenses, loans. It can get messy fast. T accounts help you organize all that chaos. They let you see how money moves, keep your books balanced, and make sure nothing's missing. Plus, they're a lifesaver when you're learning accounting or preparing for exams. Trust me, once you get the hang of this, you'll wonder how you ever lived without them. How does a T account work? Let's break it down. Every T account has a title, like cash, revenue, or expenses, and it tracks increases and decreases for that specific thing. Here's the golden rule. Debits go on the left, and usually mean an increase in assets, like cash or expenses. Credits go on the right and usually mean an increase in liabilities, equity, or revenue. Sounds tricky? Don't worry. Let's see it in action with a real example. Example 1. Imagine you start a small business and invest $5,000 of your own money into it. In accounting, this affects two accounts, cash and owner's equity. Cash increases by $5,000, so we put $5,000 on the debit side of the cash T account, because it's an asset going up. Owner's equity also increases by $5,000 because it's your contribution to the business. Equity goes up with a credit, so we put $5,000 on the right side of the owner's equity T account. Example 2, a business transaction. Now let's level up. Say your business buys a $2,000 computer, but you only pay $1,000 in cash now and owe the rest later. Here's how it shakes out. Cash decreases by $1,000. Since cash is an asset, a decrease goes on the credit side. Equipment increases by $2,000, the full value of the computer. Assets increase with a debit, so $2,000 goes on the left. You still owe $1,000. Which is a liability called accounts payable. Liabilities increase with a credit, so $1,000 goes on the right. Check this out. $2,000 in debits, equipment, equals $1,000. $1,000 in credits, cash, plus accounts payable. Balanced again. Pro tips for T accounts. Before we wrap up, here are some pro tips. Always label your T accounts clearly so you don't mix them up. Double-check that debits equal credits. Mistakes love to hide there. Practice with small transactions first. Then tackle the big ones. T accounts are like your accounting superpower. Once you master them, you'll breeze through your books. And there you have it. Everything you need to know about T accounts, from what they are to how they work with examples. What did you think of this breakdown? Drop a comment below. Tell me if you've used T accounts before or if this cleared up any confusion for you. If you found this helpful, give it a big thumbs up, share it with your friends, and hit that subscribe button so you don't miss our next accounting adventure. See you in the next video. Keep crunching those numbers like a pro.